This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, banks are now 48 hours from a liquidity nightmare, and you're not going to believe what just happened and why it means that we could be on the cusp of the next financial crisis. Now let's head over to Zero Hedge, where we picked today's story up because something serious went wrong in the banking system on Friday and setting the stage of what could happen in the markets, in the banking system when everything reopens on January 2nd. The question we're going to try to answer is this just some routine glitch in the system, or are we on the cusp of an all-out financial crisis starting in 2024. Let's pick things up with the headline that SOFR suddenly soars to record high. Its key funding spread hints at imminent liquidity crunch. And in fact, it does actually mean there's a liquidity crunch, because what's going on in the banking system isn't so much a cash shortage, it's a collateral shortage. And what you need to understand is the U.S. banking system and the financial system is highly collateralized, meaning it is very dependent on what is considered pristine collateral, and that means by regulation, Treasury bills. So when you start to see these issues of liquidity or collateral shortages, it tells you something's wrong in the banking system, something severe. Because in any normal day of operation, there isn't enough collateral to go around. And this is a problem that started with the U.S. Treasury because they insist on refining a lot of our short-term debt into intermediate and long-term, leaving the banking system perpetually short of what is pristine collateral. Now, what happens is when things in the system go wrong, everyone has a mad dash for collateral because they need to show the regulators they've got it. If they don't, the next thing you know, everything starts to fail. You have banks and financial institutions holding fire sales because they don't have the collateral to back their assets. So when you start to see these headlines, it tells you something is seriously wrong in the system, or at least it has the potential to. Now, let's start out by addressing what this SOFR thing is. It's a secured overnight financing rate data. And what this is a broad measure of the cost of borrowing cash overnight. And here's the keywords: collateralized by Treasury securities. So when you see a jump in this rate, the initial glance is, well, there's a cash shortage. No, the actual issue is there is a collateral shortage, and that's why the cost of this is going up. And that happens when all of a sudden banks and financial institutions perceive that they need collateral and they need it now. So what is the reason they need it? Is it because there's some regulatory issue they're dealing with as we go into year end, or is it a sign that something in the financial system is breaking and they're all running to get their hands on what collateral they can just as quickly as possible? And that is what we're seeing here in SOFR. Over a month ago, and well before the Fed's, quote, shocking dovish pivot, as the Fed's overnight reverse repo, which we'll talk about more what that is, tumbled below $900 billion for the first time since June of 2021, amid a growing debate of where and when the Fed's reserve scarcity, and we're going to deal with reserves here in a bit as well, that constraint will be hit. Now, I want to touch on this for a moment, that I don't buy that there is a reserve scarcity in the system at all. I'm going to show you that later in the show, what reserves are, where the levels are at, and why I think it doesn't matter. One of the issues is it matters to the Fed. And then when Jerome Powell goes in front of Congress, he talks about the financial system and the banks needing an adequate amount of reserves. What no one asks them are, well, what are reserves and why do we need them? Well, it's just a guessing game. They have no clue if we need them or not. The issue is we have them, and everyone's convinced there's some minimum level here. And they warned, this was Zero Hedge, that liquidity is rapidly approaching the reverse repo constraint limit. Again, we're going to hit on that because I completely disagree with that. I'll explain that in a moment, which could emerge as soon as the reverse repo facility dropped to $700 billion. Again, I don't understand where this number is coming from, but again, the issue is we're trying to determine, is there an all-out crisis coming that we're going to see when markets open on January 2nd, or at which point, according to Zero Hedge, that the market's all-important credit plumbing, and here's the issue, will start to crack. And that would be the initial signs. When everyone's running for collateral, it tells you the system is breaking. This is exactly what happened going into the global financial crisis. The banks started hemorrhaging, everything started breaking. There was a dash for collateral, and rates outright collapsed. So now that you kind of understand the setup, let's continue digging deeper here. Because overnight reverse repo, this from the Fed database, we'll look at a chart in a moment, are temporary open market operations that involve short-term repurchase and reverse repurchase agreements. And here's the part, I don't even agree with the rest of this, that are designed to temporarily add or drain reserves available to the banking system and influence day-to-day trading in the federal funds market. Now, what we're focused here on is the overnight reverse repo, which is, again, by the first word of the term, overnight. This is an overnight loan from the Federal Reserve. The question is, what are you putting up as collateral, and what are you getting in exchange? So let's take a look here, is which the New York Fed, under the authorization and direction of course, Jerome Powell and the Federal Open Market Committee, sells a security, so there's a key word, sells a security to an eligible counterparty when the agreement to repurchase that same security at a specified price at a specified time being the very next day. For these transaction eligible securities are U.S. Treasuries. There's a key point of what the issue is here. So overnight reverse repo, and we're going to look at a chart in a moment, is right now being heavily used by money markets because there's a collateral shortage. Now, if you look at the Money Market Act of what it takes for a money market fund to run, they have to back all that cash with collateral. Now, what is that collateral? Well, according to the law, it could be virtually anything, but if you read the law, it says it has to be a T-bill, even though it does not specifically state that it has to be a T-bill. All the rules and regulations state that of what it has to be can only be matched with a T-bill. So when we see this overnight reverse repo take off, it tells us there is a collateral shortage because money market funds who would normally back your cash with T-bills, well, what that means is they can't get enough of them, and so they have to turn to the Fed, who is again lending them on an overnight basis the Treasury securities. Now let's take a look here at a big picture of the overnight reverse repo, and then we're going to zoom into what happened on Friday. And I want you to see that overall, throughout history, this thing is virtually nothing to even be concerned about. In fact, if you're worried about what's going on in overnight reverse repo, I suggest you find some other charts, because this just tells you one thing and one thing only, and that is there's a collateral shortage. And here we can see around 2021, there was indeed a collateral shortage. That means we didn't have enough T-bills in the system. And so what happened? Money market funds went to the Fed for those overnight securities so they could meet their regulatory requirements. And lo and behold, as the government started issuing more T-bills, which we can thank Janet Yellen for, what happened is all of a sudden these money market funds could get the collateral they need, and so they're weaning themselves off of course, the Federal Reserve System, telling us that yes, there's collateral coming into the system. But all of a sudden now, on Friday, there's a mad dash for it. Let's zoom in and take a further look. Because here's what you can see, all of a sudden this is a spike that's gotten everyone concerned, because when banks start grabbing collateral, it tells you there is a serious problem in the system, or perhaps there's something else going on we can't see. We didn't have to wait long, because just a few days later on December 1st, now we're going to go back in time here a little bit following this Zero Hedge article, just after the customary month-end window dressing period, when reserve repo tumbled to a fresh multi-year low of $765 billion. Now, the reason I showed you that long-range chart of overnight reverse repo is for one very specific reason. There's no constraint level on it. There is no issue. If there's enough collateral in the system, or enough T-bills in this case, well, the money market funds shouldn't need to go to the Fed to get the securities they need, and there shouldn't be an issue. So the idea that there's some magic line that if overnight reverse repo falls below, there's problems, I don't see that at all. What it tells me is finally Janet Yellen is doing her job. Instead of refining her short-term debt into intermediate and long-term debt, she's actually listening to the system that she was once in charge of as the head of the Federal Reserve, and is realizing we need a very large supply of T-bills to deal with the mountain of regulation that Congress pushes through, that tells everyone in the banking and the financial system that as you have much breathe, you better have some collateral to back it. And finally, they're doing that. So as we dig deeper here, things indeed broke, as we explained in the quote, sudden spike in SOFR hints at mounting reserve shortage. Again, I don't think there's a reserve shortage. As I'm trying to make the case, there's a collateral shortage here, and that could lead to the early start of QE. Now, of course, if you know anything about what QE does, and of course, anything that you think it does, the market's perception is actually the opposite. But what it means to the market is that interest rates are coming down. Now, that's a play that you'd want to get in on, but let's dig deeper here. Because if we correctly previewed the coming Fed pivot, suggesting the Fed realizes there's a problem in the banking system, and there is, because they created it, at a time when most were still dead certain that Powell would only care about inflation for months to come, that's when the all-important SOFR rate, i.e. the new LIBOR, unexpectedly jumped to the highest on record, again telling us there's a collateral issue in the system here. And that means, of course, if there is a liquidity crisis, that means rates are going to come down in a massive way. The Fed's going to cut rates. They're going to do QE. They're going to all out crash. And one of the key things is this is a trade that you could take advantage of. Let's give you an update on what's going on. We'll show you what happened in the bond market, but more importantly, many of you said, Steve, can you make your reports just so easy? I don't have time. I love them, but I don't have time every day to pour through them and find the signals. Can you give it to me? It's coming. My program telling me sometime in January he's done. And right now I put 3 coupon codes for both of them up for a free month, so you can jump on that. Now, our CTA Timer Pro, you want to find signals faster than anything else. When you know machines are positioned, this gives you the edge, because we do historical overlay, so we show you when they're on the wrong side of the trade, when they're at extremes. We tell you when the flip is, we tell you when to buy. Here it was, TLT came off a max short position. That's our first signal. That was on November 2nd. We pair that with our Momentum Timer Pro. Now, many of you try to trade these technical signals. The best way to do it is that you got to aggregate them all together, smooth them all out. We do that for you. Here you see on November 2nd, a 1 daily count is momentum shifted higher on a technical basis. You pair those together. You would have bought this green candlestick at open, and right now you'd be laughing because you'd be up 14.1% on what was one of the easiest trades that nobody thought was going to happen. And going into liquidity crisis, that number is going to go up substantially. So again, links in the description below for both. Grab one of those coupon codes if you can. If it's not there when you get to checkout, it means 3 people beat you to it. Got to look for a different day then. Now let's talk about these reserves of depository institutions. There's currently 3.4 trillion of them rolling around. Now the issue is that enough? And that's, of course, the mystique of the Fed, because when Powell goes in front of Congress, he tells them, well, we have the system has an adequate amount of reserves, or we need more, or we need less. And of course, no one asks the question, what are reserves? Why do we need them? Where's the math behind it? Nope, it's just whatever they decide at the time, because nobody actually knows what they do or why we need them. And that's why I put this chart up here for you, because once upon a time, well, for many decades, we actually didn't need any. And now apparently we need a lot of them, and 3.4 trillion. Again, the issue here is I want you to see Wall Street's reaction and what these experts are saying of what they think. Because again, nobody actually knows. And what I'm trying to point out is we have a major collateral issue, and that tells us liquidity crisis could be imminent. The spike caught almost everyone by surprise, even such Fed-watching luminaries as Bank of America's Mark Cabana, because it was with, quote, no new U.S. Treasury settlements, essentially no new issuance, lower repo volumes, and lower sponsored bilateral volumes. More ominously, in confirming our take from 3 weeks ago, Cabana warned at the time the move is consistent with the theme of less cash, and I don't get that, and more collateral. In fact, I think it's just the opposite. Everything's telling me we got a collateral shortage. That is the problem. It's not a cash issue at all. And this may have led to a growing reserve scarcity that's exacerbated by elevated dealer inventories, bilateral borrowing needs, and limited access to cash to backstop repo. If funding pressures persist, it risks the Fed reassessment of ample banking system reserves. Again, there's 3.4 trillion. How many do we really need? And potential early into QT, a resumption of QE, rates going down, liquidity crisis happening, and those in that bond trade making an outright fortune. But here we can see, until today, not only when did SOFR hit a new record high, which suggests again, this is a collateral shortage, ironically at a time when the market is pricing pricing in more than 6 rate cuts now for 2024, suggesting, as we've made the case, these inverted yield curves and inverted money curves mean that inflation is not an issue. It tells us growth and inflation is coming down, rates are coming down, and it does risk an entire financial crisis. That's the real issue of what is coming. And while there's no specific catalyst behind the sudden spike, so now we get to what's really the issue here is even in the system itself, as people that are watching it, that are alleged experts on it, they didn't see this coming. And so all of a sudden there's a spike, this collateral shortage, the SOFR jumps, and everyone starts to ask the question is, what is it? Because if it does mean there's a problem, things are about to get much worse. The two factors are likely culprits: a year-end liquidity crunch, which could be the case, and the recent sharp increase in the Fed's reverse repo facility, which was actually just an evidence of that, which has increased from a multi-year low of $683 billion to yesterday's $830 billion, at which strategists expect will shoot up above $1 trillion. In today's final for 2023 reverse repo operation, as a whopping $300 billion in short-term liquidity is pulled from markets in just days, suggesting that people indeed need collateral. And who has an unlimited amount of collateral? Well, the Fed has it. So again, this is just a loan from the Fed. But look at how the market reacted here. We saw this in the bond market as treasuries tremble after $1 trillion reverse repo drains $190 billion in liquidity. This was just an offshoot reaction to it. An additional factor for the sudden drop in bond prices may have been today's month-end index pricing. It could be nothing more than that. It was a gut reaction. There's nothing that tells you if there's a collateral shortage. It does not mean that for some reason interest rates go up. It actually means it goes down. So what you're seeing here is just market participants not knowing what was going on and having some just weird reaction to it. Still, between the index pricing and liquidity drain, even a small scale order would have had an outsized effect. And sure enough, one look at 30-year Treasury futures shows that that's precisely what happened if someone came in and sold. Wasn't big, but because there was no liquidity, it caused prices to drop. But here we dig deeper into the banks because, again, the case here is a cash issue. My case, it's a collateral issue, and maybe there's something going on with the banks that we can find here that tells us they are indeed hemorrhaging. In fact, we know there's a problem because the small and mid-sized regional banks, we already know this. They're massively insolvent. As U.S. banks suffer $1 trillion deposit loss in 2023, as small bank capitalization remains, well, problematic. And here we can see that money market funds saw outflows of around $1.15 trillion, almost perfectly mirroring the deposit exodus from the banks. So money's leaving the banking system. Who cares? It's going into money markets. And guess what money markets need? So you see how this is all coming full circle here? There's a collateral shortage. Everyone needs T-bills. Now, if there's a crisis or we see the Fed cut rates, which would happen due to a crisis, what's going to happen is money in money market, it's going to flow all the way back into the banks, and that, of course, collateral shortage will be at ease a little bit. But breaking down the outflows, it's clear that large banks have suffered more pain in referring to cash leaving the system, as large banks saw around $800 billion in deposit outflows this year, as small banks saw around $300 billion in deposit outflows, both for the largest ever annual decline on record. And of course, it makes sense because banks were stuck with these low-yielding treasury securities. They were forced to buy during the pandemic because there was all this cash stuffed into the system, and now depositors are seeking higher rates than money markets can offer because they can go get competitive rates where the banks just can't right now because the Fed raised rates too quickly and put the banks in these massive unrealized losses with their treasury security portfolio, which is again one of the many cases why we're going to be back at zero on the funds rate during the next crisis. And small bank reserve ratio, this may be the real issue as we see cracks in the system starting to happen. Continue to trend in a troubling direction, but excluding the $136 billion from the Fed's BTFP, or Bank Term Funding Program, small banks are in big trouble. And the crisis back and large bank cash needs a home. Let's take a look at what, of course, Zero Hedge is saying here is what we know is liquidity is a problem for the small banks. They've got an issue. They're going to the Fed and they're borrowing money for a year-long period because they've got a major issue. Maybe the small banks are now starting to fail. That could be what we're seeing in the system here. We note reserve constraint, this for small bank cash going below, in red, going below the reserve constraint line. This, of course, is more of a regulatory issue. you see their dependency on the Bank Term Funding Program going up, suggesting that perhaps there is something breaking in the banking system, and maybe that started on Friday. The good news is that come 2024, at least back now when we open markets on January 2nd, and specifically the first trading day, we expect the reverse repo facility plummet back to $700 billion once the year-end window dressing is over. So maybe this is just nothing more than some regulatory rush at the end of the year to show that everybody needs collateral. They race to get it. They got it. Once they meet the requirements, then all of a sudden they say we don't need it anymore, and we will find that out. Again, this will be an issue starting January 2nd. So maybe this is just a nothing issue, but just a year-end thing, because as we see total U.S. debt rising above $34 trillion, we should have more collateral, because again, it floods the system with fresh liquidity, which will stabilize the monetary plumbing, at least until reverse repo dips below that key level of $700 billion. So now Zero Hedge is making the case that says, wait a minute, there still is enough collateral because the government isn't issuing enough T-bills. Again, a case that I've been baffled by for many years, because there continues to be a persistent collateral shortage, but yet they're insistent we have to issue notes and bonds because, well, why not? Well, the reason why not, Miss Yellen, is your system needs collateral because it's a collateralized system. At this point, they expect SOFR to spike and become a daily occurrence, and one which the Fed will be no longer able to ignore. So we'll see if that happens. Of course, once reverse repo eventually tumbles to zero, which is sometime by March, this is their estimate, all bets are off, and the narrative shift to the next QE will indeed begin. Of course, QE pulls liquidity from the market, but there's no relationship. If we look at the Fed's balance sheet here, what we're going to look at in red, against overnight reverse repo, there is absolutely no relationship here that anyone could make. The real question is, are we on the cusp of an all-out liquidity crisis? Well, the answer will come as soon as we get into next year and the markets reopen. Or was this simply just some year-end regulatory rush to grab collateral to show everyone that the system is solvent? We will soon find out. And if it does go in an all-out crisis, you know for sure we'll be on top of that. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.